Welcome to A Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser. Ron Corser and Associates are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids resource for a common sense approach to planning for our financial, investment, and retirement futures. He is president and founder of Ron Corser and Associates, Certified Financial Planner, CFP. Ron Corser here with us. Ron, welcome back.
Good morning, Peter, and good morning, everybody listening to today's program. Once again, we're going to talk about one of my most favorite subjects, and that's called a Roth IRA. And we're going to spend a lot of time today talking about Roth conversions and the different kinds of strategies maybe to help you build tax-free income using a Roth IRA account going forward. And just to recap, let's talk about this for a minute. Roth IRAs, what are they? They're an IRA account that you put in money that's already been taxed. It grows tax deferred, comes out tax-free. So why are they beneficial? Because the growth's tax-free. The income is tax-free. The inheritance is tax-free. Because you can withdraw initial contributions without penalty anytime you want. There's no limit. If you put $5,000 in today, you can take $5,000 out tomorrow. And depending on how old you are, you might be able to take it all out. There are no required minimum distributions on Roth IRAs. And the other part is that because you have more control over your investment options, you have a better sense and perhaps a better opportunity to do some things with your Roth 401k that may not be available in other accounts. But understand this, every day we're alive, we have a tax plan. And that tax plan has been set for us by the United States Treasury Department with help from the Internal Revenue Service. So we have that plan together. And the only question you really have to ask yourself is, do I want to endorse and comply 100% with that plan? Or do I want to take some action, if you will, to take advantage of the tax code to minimize my taxes that I pay on a long-term basis? So we're going to spend a lot of time talking about that. And what we're going to say is this: if you stay tuned, if you're driving to church, you can't take notes, but you can tune into our podcasts at www.roncorser.com and tune in on this, or you can give us a call at our office, 616-301-2581. Be more than happy to chat with you about Roths to see if they're right for you. And keep this in mind, Roth is just not something you do to do it. There has to be some thought given to it. There has to be a strategy that you use to make sure you're doing it in the most advantaged way you can between now and for as long as God lets you stay upright and live. Mm-hmm. But one of the things I always tell people is that, you already have a tax plan in place. And the question is, do you want to abide by it, or do you want to see if you can legally make some decisions to change it?
Yeah. And Ron, I think most people probably think about taxes and paying taxes maybe once a year around April when the tax filing deadline is due. But we actually pay taxes every single day, and we establish that long-term tax plan that we have for ourselves every single day as well. And that's why thinking about having a conversation about educating ourselves about the Roth option is so important. And actually in the fourth quarter of the year, as we are sort of wrapping up this year and then looking forward into future years, that's actually a particularly good time to make our Roth considerations and look at and consider strategies for paying less in tax into future years and over our lifetime.
It really is. I tell our clients and people I meet, when it comes to Roth strategy, it's important to understand that there's some deadlines involved here. One of the things we need to really recognize is there's a difference, and we're going to talk about it, the difference between contributions, having a contributory Roth strategy, and a Roth conversion. The contribution issue you have between today and the 15th of April next year to put money into a Roth IRA. We're going to talk about the limits in a minute. For conversions, meaning you're going to take money from an existing IRA account and convert it to a Roth account and pay some tax. That has to happen in the calendar year, meaning that has to happen before the 31st of December this year so that you can take full advantage of the conversion. So there's two different plans in place really for Roths. We're going to spend some time talking about the difference because there's a little confusion. Sometimes when you get on the Google search engine and you say Roth IRAs, what happens? You get about 150,000 places you can go to get information. And why do I know that? Because I do that on occasion. I have to see what our clients are Googling and what it looks like. And it scares me sometimes because I'll read some of the information and I intuitively will say with some of this, that's not right. How do I know it's not right? One of the things I tell people, and a lot of folks, some people understand it, I guess, is I've been an elite master advisor with a guy called Ed Slott since 2005. He is the premier guy in our industry that talks about IRAs, both Roth and regular. You know, you can create an IRA account at the bank with 2 pieces of paper, but the rules for taking money out of IRAs, whether they're tax deductible or tax-free Roth IRAs, is about a phone book. That's how many different rules there are.
Yeah.
So it's important to work with somebody who knows those rules, and we do, and it's important to work with somebody who has a resource that they can go to anytime and say, I got this client, I got this going on, I need some good advice. So if you're interested in talking about Roths, again, please give us a call, 616-301-2581. Be more than happy to answer your questions, or go onto our website, www.roncorser.com. You can tune in to our blogs to get more information on what we're talking about today. And you can actually just say, Ron, I got a question on Roths, give me a call. I need an answer. And we'll be more than happy to do that. Our whole purpose in dealing with today's program, and we did it earlier, is to give you the information you need to make a good decision. You know, if you have good information, the chances of making a good decision go up astronomically. And that's what we're trying to do here. Yeah. So we're going to talk about contributions versus a conversion. What does it mean? How they're different. Let's go for it.
Yeah, well, Ron, on a previous edition of the program a couple weeks back, we talked overall about Roths and tax-free retirement income being an advantage, obviously, but we didn't talk about the specific ways that people could get money into those Roth accounts. And I think that's going to be what we're talking about today, specific strategies for contributions and conversions, when and where each one may be appropriate for us. But again, ladies and gentlemen, specific direction on this is important. Pick up the phone, give Ron Corser and Associates a call, 616-301-2581, 616-301-2581. Ron, when we get paid, an employer is putting money into our hand for our job, for our sweat equity, for the work that we've put in. And let's just say that these retirement accounts, that's like putting money in our pocket. We save it for later. We take that money and we put it in one of our pockets. We've got a couple different pockets we can put it in. We can put it in the 401k or the IRA. We can put it in a tax-deferred pocket, or we could put it in a Roth tax-free pocket. A contribution is the act of putting brand new money into one of those pockets. A conversion
let's talk about that.
Is taking money out of one pocket.
Are putting new dollars.
Go ahead.
Contributions are putting new dollars into a retirement account versus a conversion, which we'll talk about, where we're taking existing dollars and making a change with them. So let's talk about contributing to a Roth IRA. Here's the first thing I want everybody to understand is you have the ability within certain guidelines to make a Roth contribution this year and every year based on current tax law, even if you're in a 401k or a 403b plan with your employer. You have the ability to do it. And it's subject to two different pieces of information. The first is how much can you contribute every year? Well, if you're under 50, you can contribute $6,000 a year to your Roth IRA. Now, here's the other part. The other part is, let's say both the husband and wife are working, or it just doesn't matter if only one of the husband or the wife is working. As long as you have $6,000 of W-2 income, you can contribute to a Roth IRA. If you have $12,000 of income under 50, you can contribute to your spouse equal amount. You just have to have the W-2 income to prove it. Now, if you're over 50, it gets a little better because they allow you to put $7,000 as opposed to $6,000 into a Roth account this year as a contribution, which means you can put away $14,000 for a husband and a wife, a spouse. Now, why is this important? Think about this. We have the ability to save in a lot of different places, but they're all basically, they boil down into three kinds of buckets. We have what we call a taxable bucket. That's where you have money in a brokerage account, a bank account, all that 1099 interest dividend stuff gets taxed. You have the tax deferred bucket, 401ks, 403bs, tax deferred IRAs. You put money in, you get a tax deduction now, you'll pay the tax man later when you take money out. Or you have a tax-free account. That's a Roth account. There's no other different kinds of accounts out there. They're either taxable, tax deferred, or they're not taxable at all. So when it comes to doing this, think about this. A lot of people have money in the bank because they like the idea, and I get that, of having ready access to cash. You know, in case the roof leaks, the tires blow up, who knows what happens. But think about this. When it comes to putting money into a Roth account, here's the key, ladies and gentlemen. If you put money, let's say you're under 50, you put $6,000 into a Roth account today. You open up your Roth account, you put $6,000 into it. Tomorrow, you can go back and take that $6,000 out. No tax penalty, no harm, no foul. They just let you do it. You can always go in and take out what you put in. So if you have a lot of money, whatever a lot may mean to you, in a bank account earning very little interest, and you have what I'm going to talk about, the income limit shortly, and you have the ability to make a contribution to a Roth account, knowing you can still go in and get what you put in there and take it out, seems to me that's a pretty easy decision to make. So one of the strategies that's really simple to accomplish is if you're sitting on money, a lot of money, whatever you call a lot in the bank, earning very little interest, and you can create a Roth account, because you're not tying up that money, so to speak. I hate that term, but a lot of people use it. Now, what is the one limitation on a Roth that everybody needs to understand? If you're a single person and you have adjusted gross income of $139,000 or more, you cannot do a Roth contribution. As a married couple, if your income is not more than $206,000, if it exceeds that, you can't do that at all. And there's a little bit of a 196, I think, to 206. So you have to be aware of the income limits. But short of that, it's hard for me to understand what the downside to taking bank money that's not earning interest, if you can do it in creating tax-free money down the road, because it's going to be incredibly wonderful to have tax-free money. And people intuitively understand it. You know, I'm amazed. We sit and talk and we do reviews with clients and we talk about the future. And one of the things everybody seems to agree with, yes, the future is scary. Yes, it's unknown. Yes, it makes no sense based on today. But most people think the potential for taxes, what we pay in tax, to increase over time, there's a high degree of potential for that. So if that makes sense and you can still go into a Roth and get the money you put back in, it's hard for me to figure out why somebody wouldn't want to do that. But I get it if you don't want to. So when it comes to contributions, you just have to be aware of, are you below 50 or above 50? Because that determines whether you can put in $6,000 or $7,000 a year. You can also put in for a spouse who's not working, and the income limitations. Other than that, it's a really simple account to open up, and it gives you all the investment options that you could have, whether you're in a 401k, an IRA, or anything else. You have almost the wide world of sports to figure out how you want to invest your money. So it seems to make sense. Those of you who are kind of interested, if you've gotten your interest, give us a call, 616-301-2581, 616-301-2581. Be more than happy to answer your questions and help you to sort through the information to make the best decision you can for yourself.
Kind of looking at this like a stepping stone progress here, Ron. If we've got an older 401k that's left at a company, then we probably don't have that choice of range of options if we rolled it into an IRA. So the 401k, usually it is recommended that we take that older 401k and roll it into an IRA. The next evolution of that would then be looking at Roth conversions and getting that money, now that we have more choice and discretion over, now getting it growing tax-free for us for our financial future. But there's a bill along the way. So again, this is where the difference between contributions and conversions comes in, correct?
Right, that's true. And there's strategies available to help. Now, I might, because you just brought this up, I'll put a little caveat in here. If you have an old 401k, and this is kind of, let's just go off the rails just a little bit here, and you're trying to make a decision as to whether you should roll it into your existing 401k with another employer or an IRA, one of the things you might take in consideration is what kind of creditor protection you can get. Now, in the state of Michigan, you get pretty good creditor protection, whether it's in an IRA or 401k. Some other states are not as, as forgiving, if you will. So one of the key issues always to think about is, if I'm going to move my old 401k, do I have creditor issues I need to be concerned about? That's just one of the things to think about, but it's important.
Well, again, there are numerous reasons why you need to look over every financial move or consideration that you are making. Ron Corser is a certified financial planner. He is an EdSlot Elite Master IRA advisor, and he's fully versed, capable to give you perspective and guidance on those retirement accounts, both from that financial perspective and with that forward-looking tax planning perspective as well. Pick up the phone, give a call, 616-301-2581, 616-301-2581, 616-301-2581. Now, the downside of making a contribution to a Roth or a conversion to a Roth, Ron, is that taxes are due at the time. There's going to be a cost to it. And that's one of the reasons why this does need careful consideration.
It is, and that's for the conversion, not necessarily for the deposit. So when we think about the conversion requires a little more in-depth thinking. It requires a little more asking questions. What's the tax implication? Because there's a cost to it. So what are we trying to do when we convert to a Roth account? We're taking money from a tax-deferred account, and we're recharacterizing it. We're changing its very nature, taking it from it's going to be taxed forever to an account that's going to be never taxed again, one time. But there's a cost to doing that, and that's the tax. And Peter, I've never met anybody in my entire life, in my 26 years in this business, wow, I didn't realize I was here that long, where people have come in and say, no, man, I want to pay all the tax I can because I really enjoy giving the government all my money. I've never met anybody that's done that. In fact, if I ever did meet anybody, I'd probably get scared because that's a frightening thing to think. So it's a little more, it requires a little more thinking. It requires a little more of a, let's create a strategy. So what does that mean? Let's say you have $100,000 in an IRA. And you would love down the road to have $100,000 in a Roth. Well, you can do it all at one time. You're going to pay some tax on that. There's some downsides to that, meaning if you're retired and on Medicare and Social Security, it could impact the cost of Medicare to you and how your Social Security is taxed. Those are some of the considerations any advisor has to bring into the forefront, into the discussion, so you know what you're doing. But the other reason is that you're going to pay tax today on it. So let's walk through this and think about how we go about doing this. One of the things that people need to understand is that in doing a conversion, what's the good side? You're going to end up putting dollars in an account that are going to grow tax deferred and tax free. The downside, you got to pay tax. So if you're going to do that, you need to walk through all the different questions. And the question is, how much should we convert? Well, the answer to that is, let's take a look at what you think your income is going to be for this year, because we have to deal with brackets. There's the 12% bracket, the 22% bracket, the 24%. You need to deal with brackets. But the key issue down the road is to always ask yourself this question: 5 or 10 years from now, am I going to pay more in tax, about the same or less? And sometimes that's not an easy question to find an answer for, because if somebody's a higher income person now, they may have less income 5 years from now. They're still living okay. They haven't given up their lifestyle. They're just making less income. So you have to consider that, because maybe that has a direct tax implication as to what you're doing.
Ron, couldn't inflation push us the other direction though? If living costs more 5 years or 10 years from now, could that push us in the other direction and make us essentially pay more in taxes, even if we are in the same tax environment, even if brackets are the same, because our need for income has gone up? Could it not push us to paying higher taxes?
It can. And the other thing that we don't talk a lot about, because it's more of a political thing, and we've just come through a political season. Taxes, the tax code, we have no control over it. We don't know down the road, 5 or 10 years from now, what the tax rules are going to be. I mean, I don't know them. I can guess, but I have no idea. That's going to be determined down in Washington, D.C., Foggy Bottom, in the House Ways and Means Committee. And a bunch of guys who have a lot of money and have their pension and health care squared away are going to determine how much we have to give up of our income every year to keep going. And nobody knows what it's going to be like. So when you're dealing with that kind of uncertainty, sometimes it's say, you know what, I think it makes at least some sense to have somebody help me walk through the steps to determine if a Roth IRA conversion strategy makes some sense. And we always encourage people, if they have a tax person that helps them with their taxes, engage those guys. They're worth paying a little extra for. We do it with our own CPA. 3 times a year, we sit with them and we say, this is what it looks like in our business. Here's the cost expenses. Here's some of the things I'm thinking about doing. What's the tax implication of that? We can do that as just normal United States taxpayers. Sit with your tax person, pay them a little extra to do some what we call tax forward planning, saying, this is about how much money I'm going to make this year, taxable. This is what I'm thinking about doing. I want to take 5,000, 20,000, 50,000, whatever the numbers is. And we generally say, give the guy 3 numbers to work with and have him do what we call a pretend tax return. So that in black and white, you can see just about what it's going to cost you in extra tax this year to convert some of your IRA. When you have that information, you can make a great decision. You can say, yes, I'm going to do it. No, I hate taxes so much, I'm not going to do it. I'll take my chances. It doesn't matter. You will not make a wrong decision. You will have investigated, uncovered everything, and you made a good decision based on what your objectives are. So that it's a win-win for you. You just got to pay the guy a few extra dollars to do the work for you, and he'll do it. And it makes great sense. Here's why I tell people this. 10 years from now, do you want to have this conversation inside your head? Oh man, I wish I had created more tax-free income when I had the chance 10 years ago, because this tax thing has gotten out of control. You don't want to have that conversation. You really don't. Unless you've said, I looked at it, I'm good with it, I'll take my chances. So give it some thought. Give us a call, 616-301-2581. We can help you with this. If you don't have a tax preparer, we can use our own CPA to do some of the heavy lifting and work for you so that you can see 1, 2, or 3 different options and make a great decision for yourself and your family.
Well, Ron, moving forward on the program today, I believe we're going to be talking about some specific strategies for those who might be otherwise income eliminated or have hit their cap and their maximum amount for contributions. We'll be talking about strategies for maximizing contributions for those without those limits or limitations. And we'll be talking about strategies for conversions, which don't have those same kind of limits and limitations. And I think that's where the biggest opportunities probably lie in today's world, because many of us have already built up large tax deferred balances in our retirement accounts. And therefore the conversion strategies may be where the majority of us have the largest opportunities, correct?
That's a good point. And here's the point that's kind of a follow-on. let's assume you've done a really great job saving and a great job investing, and you've got $1 million in your IRA. Most people will say, wow, that's really great, you got it made. I'm not like most people. I have to tell you that between 30 and 40% of that IRA is going to go away in taxes, federal, state, and local, over your lifetime. There's been studies that back that up. So you really don't have $1 million because the IRS and the Treasury Department have first dibs on your money, so to speak. So they always have to be paid. The question is, it's like that old Fram oil filter. I know I'm old enough to remember that. Where the guy slams the oil filter down and it's a $2 filter and he says, you can pay me now or you can pay me later. That's the exact same question the IRS says to us every year. You can pay me now or you can pay me later, but guess what? You're going to pay me. And we're gonna make up the rules as we go along.
Well, Ron, let's talk more specifically about those strategies when we come back here. But we talked last week about the old nursery rhyme, the fairy tale of the Billy Goat's Gruff, and how the Billy Goats told the troll, eat me later when I'm fatter. It worked out for the goats, but we're taking that same approach with our retirement accounts in the IRS, and it's not working out the same way in our happily ever after fairy tale with those retirement accounts, because the IRS realized that they did get to eat us later when the accounts were fatter, in fact. So let's talk about some strategies maybe to minimize the bites that they're going to take and keep the most of our money possible. And ladies and gentlemen, if you would like to talk with a certified financial planner about those strategies, about keeping more of your money, pick up the phone, give Ron Courser and Associates a call, 616-301-2581. That's 616-301-2581. Quick break. We'll be right back with more with Ron Courser here on Your Course to Retirement in just a moment. And welcome back into the program. This is Your Course to Retirement with Grand Rapids Certified Financial Planner, resource for a common sense approach to planning for our financial and retirement futures. He is president and founder of Ron Courser and Associates. Ron Courser with us, and we are talking today about how to get more tax-free dollars for ourselves in retirement. Roth IRAs are a great way to go about doing this, a huge advantage, we believe, for today's savers and investors, something to take advantage of. And if you've got questions about how, where, when, how much, how you can get dollars into those Roth IRAs, pick up the phone and give Ron Courser a call, 616-301-2581, 616-301-2581. Now, Ron, we talked about the reasons for the Roth IRA and the benefits of it, but how specific situations, how specific savers and investors are going to get dollars into those, it may differ. It may vary based on our specific situation. So for higher income earners or for those over certain limits and limitations, there are essentially just a handful of strategies available, aren't there?
There are. If we just look at this idea of how do I create tax-free income? Forget the details. The question is, how do I create tax-free income for myself and my family going forward? There's not a whole lot of, there's not 14 options. So some of the options, particularly for high income folks who sometimes if they exceed the limits, for some reason the government says you can't have tax-free income. Doesn't make sense to me, but I didn't make the rules. One of the things that is available to a high income wage earner, and it's a potential one, is something called a backdoor Roth conversion. Now, those of you who are interested in this, give me a call at the office, 616-301-2581. It is a little more involved in terms of what the tax rules are, but it is possible, even if you're a high income wage earner, to create Roth money for yourself, but you have to take some other extra steps to do what we call about a conversion. So it's available to people, and it makes great sense for higher income people. So I'm going to leave it with that. So anybody who wants to know more about that, give me a call, 616-301-2581. We can talk about the specifics in your specific situation to make sure, number one, we do it the right way if you want to do it, and number two, it makes sense to you. Second way to do this, and this part of just going through this whole thing, particularly for higher wage earners, one of the most overlooked accounts for creating tax-free income is life insurance. We've been through the whole gamut. I mean, when I got in this business way back in the day, I started selling life insurance in 1994. And I laugh now because that's when I found out who my real friends were. When they found out I got in the life insurance business, a lot of them wouldn't even have a cup of coffee with me anymore because they thought I was going to jump them. So I get that. It's like a funnel. You narrow all your acquaintances down to a really good hardcore group of people who are going to be your friend no matter what. But life insurance properly used and properly created in strategies makes some great sense for some higher income people. On top of that, it can provide a great long-term care benefit. So any of you who want to explore this idea, it's a little too much for our program today, give me a call at the office, 616-301-2581. Be more than happy to set up a time and just talk to you about it. I absolutely have a passion for helping people, particularly with things that are a little bit out of the ordinary, because they can be very, very advantageous to certain people who, for some reason or other, the government doesn't like them because they make too much money. And the other place we have to look is the employer plan. I ask all the people I meet for the first time, and even when we do reviews with clients, I always ask them, if you're in a 401k plan, does your employer offer a 401k Roth option? Very important, really important. Why? Because you can automatically, it's probably the easiest way to do it, and it's not related to income. You can just divert your employee contributions into the 401k plan. Instead of putting them into the tax deferred account, you put them into the Roth IRA account or Roth 401k account. Yes, you'll pay a little extra tax. You don't get a deduction, but it's an easy, quick way to save for the future, and it's free of any income limits. So it might make some sense to look at that. We've even had some clients that have gone to their employer and asked for that 401k Roth option, and they've put it in. It's becoming more and more of a standard option for a lot of plans.
And so Ron, if we do have that plan at work, we're not subject to those same limits and limitations because an IRA has a limit of $6,000 or $7,000, depending on if we're younger than 50 or over 50, whereas a plan at work, the limitations are like $19,500 or $26,000. And what we make, I believe, doesn't really matter either if we've got that plan available to us at work. So that could be a really good opportunity there.
It is. A lot of times, not only is it the easiest, but it's the best opportunity. Let's just do it, save that way, because you're accomplishing the same thing and you're not subject to income limits, which can be critical for higher income wage earners. Yeah. So thinking about other strategies, we talked briefly about it. It's really important to understand that if you're going to use a contributory Roth strategy, meaning you're going to put money into a Roth every year, you can also put money in on behalf of your spouse. If that spouse is not working, you can still do it even if they are, as long as you meet the income limits. So sometimes people overlook that. You can be part of a 401k or 403b and still contribute to a Roth IRA given certain income limits. Very important way to save. So that's one thing. Another way is to just take the employer match in a 401k if you have the Roth account, and just the employer's money has to go into the Roth, but what you do to get that money can go in, or let me back up, I just misspoke. The employee part goes into the tax deferred account all the time. The employee, did I say that right?
I get your point though here, is that the employer is nice enough to potentially give us a match, but they're not nice enough to pay our taxes for us.
That's right. So the employer contribution, what they put in for you, has to go into the tax deferred part. But what you do to get the match can go into the tax-free Roth account if you have a Roth account. It's very important to take a look at that. So there's a couple other things you can look at, but basically it gets us down to, if you have a real interest in exploring all the different possibilities for Roth money, give us a call at the office, 616-301-2581, 616-301-2581, or go to our website, www.roncourser.com. We have blogs on there that will explain all this, that have part of the radio program too. But it's really important to take advantage of it, because we don't know how long a window is. Now, one of the things I hear a lot is, well, I'm afraid to do a Roth because the government's going to change the rules. I don't believe that for a minute. Here's why. The amount of money in Roth accounts is peanuts compared to the amount of money in tax-deferred accounts that have yet to be taxed. 401ks, IRAs, 403bs, all of that. The real money in America is with the middle class. There's, depending on who you believe, there's anywhere between 22 and say $25 trillion in these tax-deferred accounts. So what's the deficit? 22 trillion? Man, there's some political math there in a heartbeat. It's easier to go after and make changes in tax-deferred planning and IRS rules. They're not going to come back and say to you, I know we gave you a tax break, now we're going to do it again. But that's just my opinion, because we vote. And the most important thing for our political people that we send to Washington every year is to make sure they get to keep their job, keep us happy, so we vote for them. They're not going to do anything to mess that up. But what I think may be a possibility, and again, it's just my opinion, they may get to the point where they say, effective the 1st of January, no more Roth accounts, period. They can do that. So what would that do for the government, and how would that help them in terms of collecting taxes? Then there would be only two buckets of money. One would be a taxable bucket where dividends, interest, and all that 1099 income gets taxed. And the other would be the tax deferred bucket, knowing that whenever you take money out, they get to tax it. So that's another reason I'm a big fan of the Roth. There's a possibility, I suppose, that maybe its lifespan is limited. So get in while the getting's good.
But they have proven in the past, when they've changed the rules, that they are likely to grandfather in people who followed the rules that applied previously. And one example of that, Ron, is the Stretch IRA. The Secure Act passed January 1st, or put into effect January 1st of 2020, basically ended the Stretch IRA. But anybody who was already receiving payments from an inherited IRA and stretching them before that time is still able to keep that Stretch IRA going. It didn't affect those previous accounts.
Exactly. And they have a reasonably good track record for government stuff to kind of look at things and say, if you have it, keep it, but nobody else can do it anymore going forward. So yeah, that's a good point.
Well, Ron, we wanted to get into a couple more of these strategies for maximizing contributions and then strategies for maximizing conversions, because we only got a limited little bit of time here. So you covered the fact that if we're married, we can double up on our contributions. We can do one for both spouses, regardless of if both are working or not. And another couple strategies here are to use your return. If you are getting a tax return, it might be good money to use as seed money to make a little bit of a contribution there to your Roth IRA. Or if you're contributing over the match at work, Ron, and you don't have the ability to have a Roth 401k, maybe that money that's over the match, we should be thinking about putting in a Roth IRA instead.
Yeah, I agree with that. And here's how I counsel people. It's important to get the clock going. It's important to have a Roth account established, because there's a clock involved with some of this. So if you establish, even if you just wanted to do $100, and I've told clients this who aren't prepared to do more, so just go to the bank and set up a Roth IRA account, put $100 in a money market. That starts the clock ticking. You have the Roth in, so that no matter what happens, government changes the rules, doesn't matter. You have the Roth, and there's a really great chance that you're going to be grandfathered in and can continue to use that down the road. I mean, it's pretty painless to do $100 at the credit union. So I encourage people to do that.
Now, Ron, one limitation previously had been that we were not allowed to contribute to an IRA, even if we were still working past 70 and a half. Roths, there has never been that limitation. So another great place to consider saving if you have that extended lifeline on your working career. If you're working past 70 or now 72, you can always contribute to that Roth IRA.
That's a great point, and it's an important point to understand, is we do have clients that work past 72 for a lot of reasons, and you can contribute to the Roth. Now, the CARES Act also said you can contribute to an IRA, a deductible tax-deferred IRA, after 72. And my response to that is, well, that's interesting. So you're already in a situation where perhaps you have the least amount of retirement income you're going to have to maintain your lifestyle, but you decide to work a little bit. So you put money into a tax deductible IRA. Well, next year you're 72, you have to take a required minimum distribution out of that tax deductible IRA. So your RMD just went up even though you got a tax deduction. I'm not sure that that strategy makes a lot of sense. It may for some people, but I think a better default, and this is just my opinion, is to use the Roth because there's no RMD on it. It passes to your spouse or children in the most wonderful way possible. There's no limitations on it. You can actually use it down the road to increase your lifestyle and to maybe manage your tax burden if you have enough money in a Roth account to use. So I would be very careful of taking advantage of a deductible IRA when you're past 72. But
Now,
again,
Ron,
that's just my opinion.
Well, I think we value your opinion as that Ed Slott Master Elite IRA advisor, as that certified financial planner CFP. This is the kind of guidance that we turn to you for. And again, it's going to be specific for everybody's individual situation, but that's why Ron offers his time to give you that kind of individual guidance and perspective on your specifics. Pick up the phone, give a call, 616-301-2581, 616-301-2581. Ron, I did a little bit of quick math here though. And if a couple is over 50 and really trying to catch up, it's possible to get nearly $80,000 into a Roth IRA or into multiple tax-free accounts, not the Roth IRA, but multiple tax-free accounts within 1 year. If both of them make their contributions to their personal Roth IRAs, and during the window of time, but kind of between tax years, between January 1st and April 15th, we've got the ability to make contributions for both years. Both of them take advantage of that double up. So that's $28,000 now. And then both of them max out their workplace plans. That's another $52,000. That's $80,000 that we could potentially get into tax-free accounts growing for ourselves. If anybody's got a windfall or an inheritance or doesn't need their income in a particular year or just is trying to really supercharge savings, these might be numbers that they should look at and need to know.
Yeah, particularly with the higher income people in the 401k plan, the max is $52,000, but that's split between tax deferred and tax free if you have the 401k option. I encourage people, please have somebody help you look at this. You know, we know our government's spending more money than they can print. And we all get frustrated about it. And it's not a political issue. We all get frustrated with it. So at some point in time, they have to come to us and say, you know, we need you to kind of step up just a little more. So the more you can do now, the better off you're going to be down the road. I'll share a little story with you. We have a client who's done a really, really great job saving in Roths. And they're going to retire in about 3 years. And we did some of that fast forward tax planning for them and try to figure out what their income needs are going to be so they maintain their lifestyle. They have done such a good job with Roth accounts that just living modestly, and they live modestly, we can get them into the zero tax bracket when they retire. What does that mean? I showed them on paper. No tax under Social Security, the taxable portion of their income is covered by the standard deduction. And the Roth money just is used to give them the lifestyle, the extra they need. Now, a lot of that doesn't happen every day. But see, with enough time planning, you can get close to that. You can start to manage your taxes a whole lot better. You're not going to be beholden to what the IRS says, even if they change the rules. It gives you freedom, it gives you control. And it keeps you from saying 5 or 10 years from now, oh man, I wish I'd listened to Courser. He talked about the Roth, but I didn't want to pay the tax. And I wish I had listened to him. I don't want that to happen to anybody listening to today's program. And I don't want it to happen to any of our clients because we actively talk to them about it. It's always your decision, ladies and gentlemen, but we just encourage people to kind of take a hard look at that and see if it can work in your life. Because if it can work, it could be the very best, most wonderful piece of money you have in retirement.
Well, again, if you'd like to take a look for your individual circumstances and situation, pick up the phone and give Ron Courser and Associates a call, 616-301-2581. That's 616-301-2581. Now, Ron, a lot of people have done a very good job in building up retirement assets, but to this point, we've kind of been taught and pushed to do so in tax deferred accounts, the traditional IRA and 401k. And so a lot of savers have a lot of money built up there yet to be taxed. What might be our best opportunity is to convert those dollars over while taxes are relatively on sale, or at least while we know what today's tax rates are and the ability to go ahead and pay them off is there. So you've got a list here of about 6 different strategies for making those conversions that I think a lot of people who are maybe nearing retirement or 5 to 10 years out from it should consider. Even those already retired, these might be some good ideas for them on strategies for conversions. The first on the list, Ron, maximizing our bracket. And we don't often think about bringing our taxable income up as high as possible, but there are times where we want to maximize the amount of income that we have taken and realized within our bracket.
That's very true. If we think about the 12% bracket, a lot of people have taxable income, say, of $60,000. I mean, they're great savers. They have more net worth than that, but that's about what they're bringing in. Well, we've got about $18,000 to play with to stay in that same bracket. And what that simply means is for any additional money you put into there, you're going to pay 12 cents on a dollar in tax, and including then the state. So it's an interesting concept because you touched on something that Slot always talks about. Taxes are on sale. What a concept. How can taxes be on sale? Well, they're probably going to be as low today as they will ever be the rest of our life. We sense that. So if you're going to pay the guy, it's the Fram oil filter, pay him now, pay him later. Doesn't it make sense to at least take a look at paying a little more now to save a whole bunch more in the future?
Well, the other thing, Ron, we all love that sale rack. When we go in and we're shopping and we see something is discounted 50% off original price, 70% off original price, we sort of are attracted to those deals. But more than likely, that is not something that we have to buy, that we have a compulsory purchase. Taxes are something that are mandatory. Sooner or later, taxes are going to be paid on those accounts. So why not make that purchase when taxes are on sale?
Yeah, that makes great sense. And the second one is that those of us who have been kind of trained all of our life to love the return. You ask people, how'd you do with the tax world? Well, I got money back. That seems to sum it up. But all we really did was loan the government money for a while. So one way to approach that return is to use that money to create a Roth account, depending on your income limits. So that's another good strategy because you haven't lived on it for the whole year. I know there are people who live on it when they get it. That may require some changes. But for a lot of folks, it's just money that they never think about. So that's another approach to take.
So, Ron, we mentioned using the return for those who could make new contributions, but in this case, you're saying use the return to pay for a conversion. So if we're, for instance, getting $4,000 back, we might be able to pay for a $20,000 Roth conversion if we've already exceeded limits or limitations on new contributions.
Yeah, and we can show you how the math works on that. But it's possible to say, well, that means I can put $20,000 if you're in a 12% bracket, for example. I can put $20,000 into a Roth from $20,000 of a tax deferred account, and I have other money to pay the tax. It's another way to do it. It just takes a little more doing some arithmetic and math to help people with that.
And a couple others, Ron, you have here using extra savings, using your RMD, using Social Security. I know with the RMD, we cannot convert an RMD, but the same concept here. If we take the RMD, we pay the taxes on that, the net we might be able to use to convert additional dollars out of the traditional IRA and over to the Roth.
Yeah, you can't convert an RMD, but you can certainly use that to pay the tax on something. And there's one other one that we ran into in March, and it's worked very well for people. When there is a market correction, a downturn, I'm not praying for another debacle like we had in March, but when the market's correct, what a great opportunity potentially to look to convert some money into a Roth. What do I mean by that? Let's say you have a great stock. You really like the stock and it's selling for $30 a share and the market corrects 10%. Maybe that stock has gone below 27, maybe it's gone to 25. You can convert that stock to a Roth in hopes that you're convinced it's going to go back up again. So you can take advantage. You know, I had a client a long time ago say, good markets, bad markets, it doesn't make any difference. Somebody's making money every day. And that's kind of the attitude you need to take. Just because there's a market correction, nobody likes that. But maybe the opportunity is, wow, we can convert a little more and hope that it'll bounce back and grow. And we'll be in better position with our Roth conversions. So that's another option to take a look at. Kind of like, what do they say? You know, you're gonna make some candy out of some garbage. Is that what they say? I don't know. I've heard that before.
I've heard a different version of it, but
yeah.
yes, I got you.
But you can always take advantage of every situation if you take a look at it and say, okay, how can I make this work for me? That's the key.
Well, again, Ron Courser's got that trained eye, an experienced professional, ladies and gentlemen, a CFP, a certified financial planner, and an elite master IRA advisor with the Ed Slott Group, capable of helping you identify where you might have some opportunities to keep more of your money and grow more money tax-free, tax-advantaged into the future. Pick up the phone, give a call, 616-301-2581, 616-301-2581, 616-301-2581. And there's a big difference between looking back at last year and saving a little bit of money doing the tax prep and then tax planning for all the years looking forward. Ron Courser has that proactive, forward-looking approach to keeping as much of your money as possible. It makes a difference because being efficient with taxes can be as effective, if not more effective, and usually with far less risk than shooting for higher returns in the market. And keeping more of your money, prepaying some of those taxes, is equivalent to having saved more of it. So, Ron, we always appreciate your time, your perspective here on the program, and giving these tips to savers and investors so they can have a more prosperous financial future.
Well, this has been fun, and I hope everybody got a nugget or two out of this. Give us a call if figuring out if a Roth idea works for you in your life. 616-301-2581. Have a blessed Sunday, ladies and gentlemen.
Tune in to Ron Courser's full radio program, A Course to Retirement, Sunday mornings at 9 a.m. on WOOD, and visit roncourser.com for many valuable resources, including other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Advisory services offered through Brookstone Capital Management, a registered investment advisor.